Hello, everyone. This is Lonnie Matthews. I wanted to go ahead and do this slideshow, and we're going to try to experiment by adding more content to the course as well as making the discussions a little bit more interactive. So you want to watch this short presentation and then use the information from this presentation to complete the discussion question. And we're going to continue to add these presentations throughout the semester. So please be patient with me. I'm going to try to get to a point where I'm ahead and we can get this done. All right, so Chapter 2 is the chapter that we're on this week, and we're actually discussing the accounting equation, and the accounting equation is the foundation for the course, and basically it consists of three things that we're going to talk about. So first of all, the first part of the equation, it simply says assets. Assets are owned by a business that's going to provide future benefits. So anything that the business owns that has value and that's going to be used for business purposes is considered an asset. Now, keep in mind the asset that doesn't have to be owned. It must be owned and not rented. So what that means is if a business owner is leasing space, they can't count the building, pardon me, they can't count the building as an asset to the business because the business doesn't own it. They're simply leasing space. So things like that you want to keep in mind as you navigate the course. Now, an asset is anything, again, owned by a business that's going to provide future benefit. It doesn't need to be paid off, though. So if a person or a business owner decides to buy a van to use to make deliveries, and they are making payments on the van, and ultimately they will own the van, then that is considered an asset to the business. And the van itself, it has value, and it's used for business purposes, so that's what makes the van an asset. So make sure you keep that in mind and you have a clear definition of what an asset. Some of the typical assets that we're going to talk about in this course are cash, merchandise, furniture, fixtures, and accounts receivables. I want to spend a few seconds talking about what accounts receivable is. Basically, accounts receivable is any money owed to the business by its customers as a result of making a sale on credit or on account. So simply put, when you see a transaction that says on account or on credit, what that's simply saying is that a customer came in, we provided them with services, and they didn't pay us right away. Let's say that I'm a lawyer and a customer comes in, or I'm a consultant. Let's just use that's a better example. I'm a consultant. I come in, I consult with a business. I give them some ideas and some things to work on. Once my job is done, and I will send them an invoice, and now the customer owes me the money for the consulting job that I did with them. That then is an accounts receivable. So I'm going to record the income under the revenues, but I'm not going to have the money until they pay me the bill sometime later. That's accounts receivable. The other option would be if the customer paid me cash or wrote me a check as soon as I got done. That's a different type of transaction that you will learn as we go through. But accounts receivable is where I did the work, I sent them a bill, and I'm waiting on the cash to come in. All right? So the other part of the accounting equation, this is on the other side here, and we're going to see here in a moment, is the liabilities. And liabilities are probable future outflow of assets that result as part of a past transaction or event. So in other words, if we borrow money for business purposes, then that makes me liable to pay it back. Hence, it's called a liability. Or in the case where if someone did some work for us and they sent us an invoice, that would be a liability to us. That means that's money that we need to pay out in the future. So basically, liabilities are obligations of the business that need to be paid out over time. In this chapter or this text, for the most part, we're only going to deal with two types of liabilities. One is accounts payable, and the other one is a notes payable. And an accounts payable is the opposite of an accounts receivable. Remember, accounts receivable is I'm waiting to receive money. Accounts payable is I'm waiting to pay money out. So an accounts payable is a unwritten promise to pay a supplier an asset for asset purchase or services performed. So don't confuse the two. Make sure you keep those two separate in your mind. One is I'm receiving the money, other one is I'm paying the money. All right. The last part of the accounting equation is owner's equity. That's the portion of the business that the owner owns. It's also called the net worth or capital, the owner's capital in the business. All right. So let's say here we have an example. If a business had $100,000 in assets and $60,000 in liabilities, that means the owner's equity is $40,000. The owner would then have worth of $40,000 in their business. So if the owner decided at any given point to sell all of the assets, they would get $100,000 in cash. Then they would have to pay back the $60,000 they owe, and then that would leave them with $40,000. That is the owner's equity portion of the business. So again, the left side are the assets. So the equation is written as follows. Assets equals liabilities plus owner's equity. At any given time, this equation needs to stay in balance. So if you get a transaction, and we usually call the double entry transaction system, where both sides or at least two types of accounts are going to be affected, and you got to make sure that this thing stays in balance. I'm going to walk you through an example here on how to enter a transaction. But before we do that, let me share with you a process. This is what I call the process. And in the process, there are 3 questions that you want to ask yourself before you put any entry into the accounting system. This is called, again, the process. And there are 3 questions. First question you're going to ask yourself is, what happened? And that's a very basic question. You don't want to overthink it. Just ask yourself what's going on. Whenever you read a transaction, just say, what is going on with this transaction? And I'm going to show you an example, all right? But the first thing to ask is what happened. You want to make sure you understand what is really going on, what is taking place, and how this is going to affect the accounting equation. Then you ask yourself what accounts would be affected by this. You're going to identify whether it's an asset, liability, or owner's equity, and then what accounts under those categories will be affected. So number 2 question is, what accounts are affected? What accounts are affected? And then the third one, how is the accounting equation affected? In other words, am I going to increase an account, decrease an account? And I want to make sure that the accounting equation is still in balance once I get done with this particular transaction. So let me show you now what I mean by the process using these 3 questions. Here we have Miss Mary Garcia. Miss Garcia started a consulting firm after being in business, after working for someone for a while. She decided to start her very own business. So what she does is she goes down to the courthouse, gets the paperwork together, and she starts her business. She opens up a checking account, which, by the way, you should keep your checking accounts for your business and personal lives separate. So here, it says here, Mary Garcia, the owner, invested $25,000 in her new business. In her new business. So the first question is, what happened? What happened? Mary took $25,000 from her personal bank and deposited it into her new account in the business. So very basic question. Don't read too much into it. I just want to make sure you have an understanding of what actually took place. The second part, or second question, is what accounts would be involved in this? Well, cash is one of them, and capital is the other one, right? We can also say that cash is an asset, and capital belongs under the owner's equity portion of the business, all right? Now, the next thing you want to determine is, how was the accounting equation affected? Was it an increase or decrease? Well, both of these accounts increased. The cash side increased, as well as the capital side increased. So when you enter that into the accounting equation, here's what it looks like. You're going to enter a positive, or you're going to enter $25,000 under the cash, so my assets went up. Now remember, this is an equation, so if one side goes up, the other side has to go up for this thing to stay in balance. That's mandatory. So we're going to enter the $25,000 under the equity section, because that's owner's equity. Remember, it wasn't a liability because they didn't borrow the money. He invested the money in the business, or she invested the money in the business. So that's an example of how each transaction is entered in. Your task for this chapter would be to determine whether it's an asset, liability, or owner's equity, and determine whether it went up or down, and enter it in and maintain balancing in the equation. So this was just a quick, short little lesson here on what we're going to learn for this chapter. Hopefully you have a chance to read it. Now, what you want to do is go ahead to the discussion question and answer the discussion questions presented to you based on what you learned in this short presentation, as well as what you learned in your chapter reading. So this is Lonnie Matthews. Thank you so much for your time. I'm super excited that you are taking this course.